Prismatics Financial Institute.
And in the bottom there, you've got multiple teams. So what we're seeing is firms thinking, well, climate risk is going to affect credit risk, operational risk, maybe legal risk, reputational risk, and those teams need to embed it within their processes. So that's a very common thing that we're seeing. I think I'd also add a further trend probably and it links to the scenarios actually and the net zero emissions targets in particular. But firms are increasingly interested in aligning their portfolios to a particular emissions pathway. So, for example, they may say, right, this portfolio is aligned to a 2-degree scenario. So that's where firms are thinking not just about the impact of climate risk on their balance sheet or on their portfolios, but it's also thinking about the impact of those portfolios on the climate, which is one of those two perspectives that Maxine was talking about earlier on. So I think that probably outlines the key trends that we're seeing. I'm sure there are many others, but for risk professionals, they're the ones that we would highlight as being particularly important. And now I'm going to turn back to Maxine to talk about some of the very real current challenges that risk professionals are facing.
Thanks, Jo. So I'm going to have a look at some of the key points that we found in last year's survey. So in our survey, we saw that many firms have reviewed the impacts of climate risk on their business. However, converting that impact into product pricing is another matter, with only about 4% of the respondents thought that climate risk has been priced correctly, with the vast majority thinking it was either not included in the market's pricing of products, or if it was included, it was only included partially. And some of the challenges that were noted to include the pricing of climate risk is that the longer term forecasting of climate change and its impacts is quite complex, lack of robust and reliable data, and also the difficulty of combining the short-term focus of pricing models with the long-term nature of climate risks. I'm sure we're going to see a lot more in that space going forward. Now, we also looked at this lack of pricing was also compounded, or the inability to price was compounded by other concerns. And over the short term, we saw the availability of reliable models is a significant concern for the greatest number of firms. And this could be due to traditional risk management tools not having been designed, again, for this longer term nature of climate risk. Firms also rated regulatory uncertainty as a concern of high significance in the short term. And interestingly, the third most common area of concern is getting internal alignment on climate strategy. So there's still work to do for all areas of a business to understand and agree on its potential impact and how climate risk should be addressed. Now, there's also a lot of discussion around whether climate risk should be treated as a principal risk or embedded within existing risk types. Now, only a minority of respondents considered climate financial risk as a principal risk. The majority considered it as a factor in other risk types, principally credit, market and operational risk, so within their largest risk types. And this explains why climate risk expertise is being embedded into existing risk teams, because it needs to be reflected in existing risks. And the Banco de Mexico also recognises this risk, and in the 2020 report I mentioned earlier, it was noted that it's critical that financial and risk management practices recognise environmental externalities and risks, as these can have major consequences on credit risk, financial stability and social development across time. So the regulators are aware of this, even if they're not sure yet how to deal with it, they're also turning their focus to it. Now, due to the uncertain nature of climate risk, scenario analysis is one of those key tools to understand it. And we've found that more than half of the participants use scenario analysis, and then we did some further investigation and found that all of the leading firms use scenario analysis as a tool to understand their climate risk. And of the firms that use scenario analysis, they tend to use it more on an ad hoc basis, than as a regular part of risk assessment. I think we'll probably see that evolving as firms improve their scenario analysis practices. And more than half of the firms using scenario analysis have taken action, which was an increase from the previous year, which indicates that scenario analysis is becoming more embedded in the risk management process. So what measures are firms using to embed climate risk into their day-to-day processes? Now, we saw that around 2/3 of firms in our sample use metrics, around a half use targets, but only a third use limits. So this implies that while firms have decided on a way to measure the climate risk that their business is exposed to, they haven't yet decided what an acceptable exposure is, nor the maximum exposure that they're prepared to have. Looking at the column on the right, we can also see there's a large divergence of practice. A quarter of firms are not measuring their climate risk at all, and on the other hand, about a quarter use metrics, targets and limits, while the remaining half use only one or two of metrics, targets and limits. So now over to you, Jo, to take us through how risk professionals can learn more about this risk.
Great. Thanks very much. So we're on to the last part of the journey, and we thought we would just outline some of the ways that, if you're wondering where to start, here's some just practical ideas on how to get going. So an important part of an area for risk professionals to learn more, an important way that they can learn more, is through benchmarking. And I think this is particularly important when you're dealing with a new and less mature area of risk. And it can also help accelerate the learning and the establishment of leading practices. So the results you just saw from our survey is one way that we try and help firms by providing benchmarking for them. We do a lot of benchmarking at GARP, and the climate survey is just one of the ways that we do it. But this chart shows you the structure of the survey that we actually provide with the firms. And it's structured along the same sort of broad categories that the TCFD, the disclosures framework, is structured along, because they are the most important kind of building blocks of good risk management, but they're also building blocks that many firms are familiar with. So we look at governance. Are the board and senior management engaged? Are they seeing papers? Are they taking decisions? That sort of thing.
Prismatics Financial Institute.